broader markets. And of course, that brings us to that recent volatility. Joining us here at the NYSE, former Gabelli Multimedia Trust Portfolio Manager Larry Haverty, now with LJH Investment Advisors. And Larry, good to see you, have you on the set.
Thanks, David.
It's rare that I get somebody older than me on the set these days. You've been in this business since '72. And so I'd love your perspective because you have seen plenty of these periods before. A, is there a period that you can sort of liken this current move to? And B, what's your takeaway right now?
Well, they're all the same and they're all different. But the key thing is there's no such thing as an intellectual bottom. There's only an emotional bottom. Get me out of here. I want to leave Dodge as quickly as possible. So what you have to look at when you're in a period like this is signs of emotional distress. And you have to get that from financial indicators. So a couple weeks ago, there were 1,700 net declines in the New York Stock Exchange. Only once in 40 years has there been a greater number. So we're in the 99th percentile of that. Last week, there was a 12-to-1 day down volume versus up volume. People not only wanted to get out, they wanted to get out quickly. So that would ring the bell that we're very, very close to an intellectual level of the bottom. Now, when you get to the bottom, I like this quote from my Russian history professor. Just when you think things couldn't possibly get any worse, he's talking about Russia, they do. So at the bottom, there's always something incrementally going wrong. And you more or less at some point have to tone out the news. Take this morning, Dick's Sporting Goods, really, really good retailer. The stock went down 15% on the quote-unquote earnings miss. Well, you can't break your neck falling out of the basement. You look at Dick's, all you know is where it is now. So the company at the bottom of trading today was at 3 times cash flow.
And look at the stock now. It is rebounded just in the last half hour.
33% return. You can't go broke buying companies at 3 times cash flow. There are a number of companies in the retail area trading at 3 to 6 times cash flow. And in the tech area, you have companies like Google and Facebook trading at 10 to 13 times cash flow.
All right, but you know, yesterday they were quite weak on, of course, that unexpected warning we got from Snap only a month after the company had reported its earnings. Plenty of people come on here and say, hey, these things are cheap. It doesn't mean they're not going to get cheaper. Why now in terms of potentially buying a Meta or an Alphabet?
Well, the thing that's different now versus 74 is companies can buy their own stock. And these people are very, very sophisticated financially. So you look at Google and you have at 13 times, it's a 7 cash flow cost. Invert 1 over 13.
Right, a 7% cash flow yield.
Yeah. Google's getting 1% sitting with the money in the bank. So you have a 600-point spread. Used to be 500 points was good. For a company like Dick's, the spread's 25, 27 points. So share repurchases are eventually going to moderate things. And I think the public's going to come back.
Why? Why do you think the public will come back?
Because what you've done right now is you're taking the baby out with the bathwater. You're selling the Googles and the Amazons. They're going down as fast as the rest of the stuff. Now, the reason that you sell these is there are buyers for them. There aren't any buyers for Snap. Snap's at the low end of the ad food chain. Google and Facebook are at the high end of the ad chain. Now, why is Facebook at the high end of the ad chain? Because people are forgetting now, Facebook's ads are economically accountable. If you advertise on Facebook, you're in the direct response business, and you can tell whether the ad works. So that's going to be the last thing that you're going to cut because you're more or less going to have to advertise. So you just take your combined learnings of where you are at this point in time and apply some of your experiences, and you more or less have to be positive because you can't break your neck falling out of the basement. And you look at the energy here in the New York Stock Exchange. We've cut out a lot of the excesses in the systems. The SPACs are dead. There aren't going to be IPOs anytime soon. So the supply of new stock, which is always a problem for the market, is drastically curtailed. You have these enormous, enormous values in the market being created right now on a cash flow basis. And at the end of the day, cash flow matters.
You've written a lot about inventories, and we're seeing them get bloated pretty quickly here in retail. Why don't you think that's going to happen in semis? Because it doesn't sound like you do.
Well, I think the semi problem is going to get corrected. Today there was a little notification that Apple was maybe not going to produce as many iPhones. Last time I looked, the iPhones used semiconductors, and they may be the ones that Apple was going to use are going to come on the market. And there's no such thing as a shortage, Carl. There's only a shortage at a price. And if the semiconductor companies who know how to price when demand is up, price their products fully, they'll meet the supply. I think the semis are going to have a rough time for a while because there are going to be order cancellations. There's excessive inventories in certain channels of retailing. Not all retailers have gotten it right. Some of them has messed up pretty big time. But there's, I think, the inflation is likely to have peaked. Nobody's talking about it right now, but lumber prices, which was one of the big engines of inflation, is down 40%.
Yeah, Carl's brought that up actually a number of times. You know, finally, I want to end with you on what we used to talk about a lot years ago, the old media, what we call old media now, advertising worries right now. Do you think they extend to the likes of a Warner Brothers Discovery or a Paramount or even a NBC Universal?
No, I'm a great believer, David, in the communal experience. And I think Jurassic Park's a great example. I remember I saw the first Jurassic Park in a theater, and I was terrified. This is a film that's being made to embrace a communal experience. People are still going to football games. They're still going to baseball games. They're going to go to theaters. And if Hollywood can produce good product like, past Jurassic Parks, I think there's no question that these companies are going to survive and prosper. And they're being given away right now, most of them.
Larry, appreciate your time.
Thanks a lot, David.